Hi, this is Tom Clendon here, your SBR online lecturer. And I thought today we'd do something slightly different in that we'd have a look at debits and credits. I'm often asked, do we need to know our debits and credits to pass this final level ACCA exam? And the answer to that is no and yes. Let me be clear, it's not a test of double entry. ACCA, SBR exam, you're never going to be directly asked what is the double entry of or show me the journal entry of. It is simply not that exam. However, as some of you will have noticed in the examiner's answers, and in some of my answers as well, I will refer to journal entries. I will refer to debits and credits because it's a beautiful shorthand. It's a beautiful way of communicating directly to other accountants what the accounting entry is. And I have seen, and I do see in the SBR exam, a requirement from time to time which says, show the accounting entries. Now, one way of answering that question to show the accounting entries is to show the debit and credit. But it's not the only way. You can talk about increasing an asset or decreasing an asset. That would equally be a way of articulating the accounting entries. And we mustn't overuse double entry, because if you're asked to explain something to a non-accountant, to explain something to a shareholder, if your explanation is a journal entry of debits and credits, I'm not sure you've chosen the right language, because it's assuming that the other person is an insider and knows the double entry system. So with that proviso in place, I want to spend a few minutes now going over the raw basics of debits and credits to give you a bit of confidence, perhaps, that you do know your debits and credits. And at the end of the podcast, or towards the end of the podcast, I've got half a dozen or so examples and tests that I'll sort of read out and call out and see if you can also talk with me about those examples. So to begin with, double entry bookkeeping is very rules based. It's very procedural based. There's no judgment or subjectivity involved. And the rules start with understanding there are 5 elements. And this takes us back to the framework. If we're going to talk about double entry bookkeeping, if we're going to talk about financial accounting, assets, liabilities, and equity are 3 elements on the statement of financial position, and income and expenses are 2 elements that we find in the statement of profit and loss. So everything in accounting is one of those 5. Assets, for example, includes cash, receivables, plant, machinery, goodwill. They can be tangible, they can be intangible, they can be investments, they can be non-current, they can be current. They're all assets. Assets are resources that we control that give us some form of economic benefit. Our second element is a liability, an obligation, something that is unavoidably going to result in an outflow of economic benefit. Trade payables, bank overdraft, debentures, debenture loans, that is, lease obligations, tax liabilities, pension fund deficits are all examples of liabilities. And they're found on the statement of financial position. Equity, our third element, equity, ownership interest. So that could be from monies originally introduced, so share capital, share premium, or it could be from profits that have been generated through the company's activities, so retained earnings or revaluation reserves, exchange differences, profits which perhaps haven't travelled through the P&L. So equity is ownership interest. The 2 that are in the income statement or the statement of profit and loss is sales income, sales, Yeah, sales, dividends receivable, sales, that examples of income, turnover, revenue, same name for sales. And of course, expenses. Our fifth and final, expenses, E for expenses. And our expenses are rent, rate, heat, light, depreciation, wages, impairment losses. They're all expenses. Sometimes expenses are paid for, so you pay wages. Sometimes expenses are non-cash expenses like bad debts and depreciation. So everything we talk about is one of 5 elements: assets, liabilities, equity, income, and expenses. Now, in terms of the rules, duality, every one transaction has 2 effects. So, if a customer pays me money that they owe me, then there's an effect on the receivable and there's an effect on the bank. So one transaction has 2 effects. If there's an impairment loss, there's a loss to record, but the asset also needs to come down. One transaction, 2 effects. And those effects will always be recorded as a debit and as a credit. So there's one debit and one credit. And this is our sort of code. This is our language. Debit is on the left. Debit is traditionally thought of as being first. And credit is on the right and is traditionally thought of second. Now, why is debit on the left and why is credit on the right? It's just tradition. Yeah. I learned to drive by driving on the left. So I always drive on the left. Debit is on the left. Drive on the left or you crash on the right. And the abbreviation for debit is DR and the abbreviation for credit is CR. These are acceptable. So let's think about how we start then with the detailed rules of when to debit and when to credit. And let's start with assets. Assets are debits. Basically, you have to remember that as your cornerstone. Assets are debits. To increase an asset is a debit. If you buy plant, debit plant. If you revalue land upwards, debit land. Assets will always be debits. Assets and expenses are very similar. They're brothers. Because in order to have an asset or in order to have an expense, very often you pay money. So you either buy the property or you rent the property. Both have involved a payment. So expenses are also debits. So when you pay wages, you debit wages. When you've got an impairment loss, you debit the impairment loss. So assets and expenses are debits. Let's just talk through those 4 transactions I've briefly mentioned. If you buy plant, the asset of plant goes up, debit plant. Now, if you've bought it for cash, the asset of cash has gone down. So you do the opposite to the debit, you do the credit cash. If you revalue land, the asset of land goes up, so you're debiting land, but you haven't paid any money out. There's a kind of profit, there's an ownership interest that goes up here, so we credit equity, we credit a revaluation reserve. If you're paying wages, then the expense of wages is a debit, and because you made a payment of wages, you're crediting cash. Asset goes down. And then with an impairment loss, what you're doing with the impairment loss is you're recognizing that loss. So that's an expense. So you're debiting the expense of impairment loss and writing the asset down. It's less of an asset. If assets go up, they're debits, but assets are here going down, so we credit the asset. Assets and expenses are debit-orientated accounts. To increase them, you debit, and therefore to decrease them, you credit. Now, the opposite of an asset is a liability, and the opposite of an expense is income. So it's perfectly logical that liabilities and income are credit-orientated accounts. Assets are debits, expenses are debits. To make them go up, they're debits. But for liabilities and income, they're credit accounts. So to increase a liability, you credit. If you were to borrow money, you'd recognize a liability by crediting the liability. You've received some cash, so you've got an increase in the asset of cash. If we make a sale of goods or services, we are recognizing the sale. We're recognizing the income by making a credit. Revenue, sales, turnover, call it what you will, is a credit. It's income. Now, what do you get in return? Either cash, so debit cash, or maybe a promise of cash, so you debit receivables, you debit the asset. Now, the fifth element is equity. The fifth element is the ownership interest. The fifth element is similar to a liability in the sense that the business owes this to the owners. It's the equity interest, the ownership interest. So it is a credit-orientated account. So let me think about various examples. Let's recap. Let's do a minor test. And I hope you might be able to kind of beat me to the punchline. First one. What's the double entry if you pay rent? So we've made a cash payment of rent. Now there are two effects. The expense has gone up of rent and the asset of bank has gone down. So to recognize the expense, you debit rent. We've made a payment, so we credit bank. We've made a cash sale. We've made a cash sale. That one transaction has two effects. We've got more cash and we've got more income. So the asset of cash is going up, debit asset. Income is going up, credit revenue, credit sales. Third transaction, we're going to revalue land. If you revalue land, no money comes in or out. But if you revalue land, there are two effects. Asset goes up and the equity goes up, the ownership interest goes up. So we debit the asset, increase in the asset, debit the asset, credit, equity, credit, revaluation reserve, or other components of equity if you prefer. We're going to repay a loan. If we repay a loan, then we're paying money out and we will owe less money. We'll have less of a liability. If we're repaying a loan, our liabilities go down and our asset of cash at bank goes down. Liabilities are credit-orientated accounts. So to debit the liability reflects the fact that it's gone down, and to credit the asset of bank reflects the fact that it's gone down. So when you pay a loan, debit the liability, debit the loan, credit the asset, credit the bank. And finally, a finance cost. When we run a finance cost, when we charge the effective rate of interest, now that's going to cause us, if we're charged interest on a loan, that's going to cause us to have an expense. The finance cost is an expense that you charge in profit. But if you are charged interest, you will owe more on the loan, so your liability will go up. So when you're charged interest, it's an expense, debit the expense, and you owe the money, so it's a credit to the liability. So I hope that's useful. You've got the opportunity of obviously playing this again if I've gone too fast, and maybe you want to make your own little notes on this. There's other stuff out there that I've done on double entry. I mean, if you go on Google, and I do a lot of stuff with PQ magazine. I've done a back to basics video on double entry, for example. I've done an article on double entry, for example, and now I'm doing this podcast. So there's other stuff out there if you wanted to watch a video. But thank you very much. Let me just recap. SBR is not a test of double entry. But double entry is, I hope, nothing to be too frightened of, because it is a rules-based approach. My name's Tom Clendon, and I teach ACCA SBR online, and I would like to thank you for listening.